What is an SMSF or a Smurf, self-managed super fund, cryptos in a Smurf, and getting into business with a franchise. Hello and welcome to another episode of the Solve to Evolve podcast. The purpose of our podcast is to give our insights to help you, the individual taxpayers, investors, and business owners, navigate your way through what's going on in Australia today. I'm Phil. We're back at the Stunt Bar in Gymea. I've got Jono and Chris with me today, once again. Gents, how are you today?
Very well, thanks, Phil. How about yourself?
I'm doing all right. There's lots going on, but yeah, surviving.
Yep.
Looking forward to the podcast today.
Excellent. So there is quite a lot happening today in Australia, and we want to cover the following 3 talking points. What is an SMSF or a Smurf, self-managed super fund? Cryptos in a Smurf, and getting into business with a franchise. To start, over the last few years, we've seen a steady rise in active Smurfs, with an increase of 4.5% in active Smurfs from the 21 financial year to the 22 financial year. As of 31 March 2023, the ATO advised that there is 606,217 Smurfs active. That's quite a lot. Bloxy, can you tell us what a self-managed super fund is?
Thanks, Phil. A self-managed super fund, for those of you out there essentially who are interested in it, it's essentially a trust. So it's a highly regulated form of trust, and it's got its own special tax rules that are in the SIS Act. SIS stands for Superannuation Industry Supervision Act. It's a form of private super fund. It's not open for any member of the public to join it. You have to be a member of the one family group to join a super fund, a self-managed super fund. And they can only have a maximum of 6 members at the moment in a self-managed super fund.
And Bloxy, why would a client or a person want to start their own self-managed fund as opposed to retail super?
That's a good question, Jono. There's a number of reasons why. So typically a client will come in who will be either a business owner or a high net worth individual, and they'll want to exit the retail superannuation environment. And the reason why they may want to exit the retail super environment is to gain control over how and where their super funds are invested into, reduce the fees that are paid on their account, and clients in business may also, importantly for the business owners out there, may also want to take advantage of buying their business real property inside their super fund and leasing it back from their super fund instead of paying rent to an external landlord. Clients may also be part of a high net worth family group and may want to use a self-managed super fund as wealth management or future planning vehicle.
So business real property, you just mean an office or a warehouse or something that's used in their business.
What's an example of that?
That's right, John. So if you're a business owner operator and you operate from a site or a premises, that is your real property that you operate a business from. And buying that, even with debt inside a super fund, is A, legal, and B, an exception to what's called the in-house assets rule. So classic example might be a doctor who owns a doctor's room, or a mechanic who owns a workshop. They can be structured in a tax-efficient way using a Smurf if the client chooses to do that with their superannuation funds.
Yep.
Yeah, so what that means is a self-managed super fund is purchasing that warehouse or that practice, and then the business owner is then paying rent to the self-managed super fund to use that premise.
That's correct.
Excellent. Okay, so with self-managed super funds, Bloxy, is it appropriate for everyone?
The short answer is no, definitely not. The main clients that a self-managed super fund is appropriate for is firstly the client who understands what a self-managed super fund is and what it's trying to achieve. Typically, they're the more engaged clients who are capable of managing the compliance workload, because unlike a retail account where you can basically forget about your super, just have your employer pump money into it and get your annual statement once a year, you don't really have to log in or do anything. It's kind of like having a bank account being in retail super. In self-managed super, you become the trustee of your own invested funds. And that puts a lot more obligations onto the members who are also trustees of a self-managed super fund to comply with the law. So you have to deal with people like us a lot more, your accountants a lot more, to do things like signing certain documents, lodging tax returns annually, reviewing accounts. So it creates a lot more work for the client, but it can also be much more rewarding. So clients who want to use their super to do highly speculative things, to trade frequently, they're typically also not ones that should be using their superannuation funds to do that, because the whole aim of super is to provide income for your retirement.
Yeah, so you really get the benefit of, it's more responsibility, but if you have that, a bit of expertise and a bit of investment knowledge, then it can be a good vehicle. And what would you say are to sum up the benefits of self-managed super?
So simply put, Jono, I would say that control. So you control what your money goes into. You have visibility over how your investments are performing. So in a retail super fund, like I said, you'll get a statement once a year that will tell you whether the unit value has gone up or down. And the returns that are quoted by retail super fund are hard to pick apart. But typically it's balance sheet movement only. Whereas in a self-managed super fund, you see the P&L as well, which is very important, particularly when you start looking at cash returns from investments, so things like dividends. You can't actually see that when you're in a retail account. So the visibility of having a self-managed account is really a critical benefit. There's also, you can use the self-managed super fund as a very effective planning tool. For example, if you have adult children that are also interested in becoming members of a self-managed super fund, you can use that to teach them and institute intergenerational ideas about investment. And that can be more valuable than monetary return. They're also typically lower cost than a retail fund, particularly if you have 4 members in the fund. So you have to look at the actual dollar cost across all members and all accounts that are sitting inside the super fund. And when you do that, assuming that you're operating in a fairly efficient way, so not doing a lot of speculative trading, not doing risky things, then the costs of administering a super fund can be quite low per member.
And just to add to that, Bloxy, I guess when individuals are invested in their retail fund, as you say, you get a document at the end of each financial year highlighting your balance and a summary of what's happened. But it's set and forget. People don't even read it sometimes, or a lot of the times. And so what you don't see then, or you don't look at it, is how much management fees you're being charged in your super fund, which can pretty much outweigh what you're paying potentially pay in a self-managed super fund.
Yeah, that's absolutely right, Phil. The fees that retail super funds charge clients, well, the ones that you see on your statement, are not the only money that the super fund makes from the client. But to peel the curtain back and actually see how much money is being extracted from the pool to pay for the administration of the super fund itself is practically impossible. There was a Royal Commission on this. The whole reason for the Royal Commission, or part of it, was to expose that, for want of a better word, a misuse in some cases of retail super funds clients' money to do things that were not benefiting the clients. Which brings us to the next benefit, probably the last benefit of joining a super fund that we'll talk about today, which is just exiting the retail swamp. Now, for a lot of people, retail may be appropriate for a lot of members because they are not engaged with their super and they don't want to participate anything more than seeing an annual statement. But if you do, you can get significantly better returns over time if you put more effort in. It's the same with anything in life. You get out what you put in.
And a few years ago, there was the suggestion of having a minimum balance. I think at one point they got up to 500,000. I don't know if it was ASIC or APRA that said that.
Sure.
They've since wound that comment back. But what do you think about how much should a person have or a fund have in it to make it worthwhile?
That's a really good question. And it depends on the temperament of the member, of the trustee member. If you've got a member who has a very long-term view, is a long-term thinker, and wants to build knowledge about how the entity operates and understands the tax efficiencies that you get with a self-managed super fund, then the sooner the better. That doesn't mean that you shouldn't roll into a self-managed super fund if you're an experienced person who's got 500,000 plus. The benefits will be there in a lower balance fund if the trustee members get value out of understanding the way that the compliance paperwork and the investment process works. The sooner that you can build that knowledge, the longer that you have with an entity, the more you're going to understand about how it works and the costs and benefits of it. So doing it as soon as possible. Like I have some clients that have their kids in. One this morning has joined it when he was 18, an apprentice electrician. So that kid, even though he's an apprentice electrician with a very low balance, is going into the mother and father's super fund and will have a very long time span to get their head around how it works and why it should, the power of the entity.
Yeah, so it's more than just numbers on a page. It's getting that knowledge and passing on to the next
Absolutely.
generation.
Investment philosophy is a key thing in a family group to manage wealth, to actually communicate and then to practically illustrate investment philosophy intergenerationally is hard to do if all of the members of the family group have separate retail account. But if you're all one part of one self-managed super fund, you can invest as a wolf pack. And that has a lot of benefits that are non-financial.
Yeah, good one, Bloxy. I guess for the viewers out there, doesn't matter what the account balance you've got in your super, but if you're committed, then start sooner rather than later.
Absolutely. Talk to your accountant, talk to your advisors and think about whether or not it's right for you.
Well, what about the costs that could be associated with getting into a self-managed super fund, Bloxy? Talk to us a little bit about that.
Sure, yeah. So to set up a self-managed super fund, typical costs around $2,000 to $3,000, and annually $2,000 to $3,000 would be a standard compliance fee. Again, you've got to look at that across the balance of the super fund, and there may be up to 6 members in it. So you need to break that down on a member by member and also on a gross balance kind of percentage basis, and compare that to what you would be paying in a standard retail account and what you would be getting from that retail account. Now, there's also another cost is the administrative burden. So like we've said, there are documents to sign every year, tax returns, accounts, which should not be dismissed. And the key to it is honesty. If you're not someone who wants to engage with boring stuff, then you probably should stay
It's not boring.
in the retail environment. It's tax returns, it's talking to accountants, it's responding to emails. There's time commitment involved, and you need to be honest with yourselves and the other trustee members in the fund to decide whether or not it will be right for you.
Thanks, Bloxy. You mentioned something a little earlier, which will segue into to Jono now. But in a Smurf, you probably don't want to be trading speculative investments just because it is a long-term investment for your retirement. But we also saw the bubble burst in 2022, and the crypto market went into free fall, and now they're in a sea of red. Jono, can you tell us what investors should consider when looking to invest in the crypto market using their self-managed super fund?
Yeah, there's quite a few things to consider. Obviously, it is a highly volatile and young market, the crypto, and doing it in a self-managed super fund, there's just an added layer of admin and things to consider so that you don't get caught out.
And what are some things that our viewers should be aware of?
Yeah, so I think you need to have a high conviction about crypto and a technical understanding of how it works. And following on from that, I'd say the number one thing is custody. So how does the self-managed super fund hold those crypto assets that you buy? The first thing to note is it needs to be, however you hold it, it needs to be legally in the name of the fund trustee as trustee for the fund. So whether you're going to an exchange, so ideally you would have an Australian exchange just because they understand the self-managed super fund entity, whereas foreign exchanges probably do not and don't care about that. So first off, that's number one, make sure that any account you open for you to purchase crypto is in the name of the super fund. And a really important one when I say custody is to read the terms and conditions of whichever exchange provider you're using, because they're all different. And in the fine print, it might say whether when you buy the crypto or even transfer Australian dollars onto that exchange, whether the fund has custody of it or not, because there's some where you transfer and at that point it's no longer your asset really. it's the exchange's asset and it's potentially at risk. So you need to be keenly aware of that. And I can tell you a real life story because it happened to me when I opened my own self-managed super fund. So what I did was, it was a small Aussie exchange and it's public knowledge. It's called Digital Surge. I transferred some money across from my bank account and I hadn't even traded crypto or bought crypto yet. That company or the exchange went into liquidation because it was caught up with FTX and that collapse.
So when you say that you transferred some money into the exchange, do you mean that you transferred some of the super fund's money?
Yeah.
From the super fund's bank account onto the exchange?
Yes. Yeah. So I had transferred some cash across. I had every intention of buying crypto, but I hadn't got around to it yet. I was being a bit greedy and waiting for the price to go down. And then that exchange went into liquidation. That's not because of the custody arrangement. That it wasn't the fund's money. I'd actually transferred it across. And anyone who's investing crypto, either personally or especially in the super fund, needs to know that and needs to be able to read the technical terms and conditions of those exchanges.
Yeah, that's a good point. And I think like many other Australians and yourself, and look, I'm guilty of it as well, we don't read the terms and conditions or the fine print. We just go ahead and buy, just, head first, right? But it is important. We are talking here about, your lifetime savings and retirement funds. If you are looking to invest a big amount, then I would say take that advice and read the conditions, or at least speak to a professional about it before getting into it.
Yeah. And last comment, I would say best practice is not to keep your crypto on an exchange.
Yeah.
Best practice is to buy it on the exchange and then immediately thereafter withdraw it to a hard wallet that you control, and you have secured the private keys of that wallet using a ledger or something like that.
Just don't lose that hard wallet ever.
Yes.
And apart from custody, Jono, what other kind of key considerations are there to be aware of for our viewers?
Number two, a close second, I'd say investment strategy. So you got to have a long-term investment strategy. You said when setting up self-managed fund, you need to have a long-term mindset. So you can't think about, if you're investing in crypto, you should definitely not do high-frequency trading, high-frequency speculation and things like that with crypto, and using leverage. Just stay away from all that BS and just focus on long-term. What's your conviction about the crypto that you're buying? And is it going to be long-term increasing value? So have an investment strategy, consider diversification. You don't want to just put all your eggs in one basket, whether that's one particular crypto. It's also considering other assets aside from crypto, like shares, because there's obvious benefits with fully franked dividend paying shares in super funds. It's the tax arbitrage that we've spoken about. And last one I'll say is document that strategy and actually think about it, because I've seen investment strategies for super funds where it's literally, it lists every asset class and the percentage is 0 to 100%, and then it's signed off. It's a bit of a joke document, right?
Yeah.
Actually turn your mind to how much crypto. Is it 5 to 10%? Is it up to 50%? And then the rest is cash or less risky, something like that.
Yeah, it's really protection for yourself.
There's some awesome great tips, and some that even Phil and I weren't really aware of. But our viewers should know that we're not financial planners, and they should always seek advice from a licensed and insured financial planner before making those investments decisions, to ensure that those decisions are right for you. Are there any pitfalls of investing super into crypto assets, Jono?
Yep, there are. Of course. And first one, just on that point, financial planners, yes, you should go get some help from a financial planner for your overall investment strategy. But when it comes to crypto, they're not going to help you. And that's because ASIC hasn't given them license to do that. So when it comes to crypto, you are basically on your own. So that's why you need to have this diligence.
Be wary
when you're doing it, right? So the pitfalls. First of all, remember that your super fund, self-managed fund, needs to pass an audit every single year. So you need to keep excellent records. The pitfalls that I've seen with clients in the past is they haven't kept all their records. They don't have records of every transaction. They don't have tax reports. They don't have the exchange reports. Some only limit you to 12 months, like Binance.
So you're saying that in some cases using third-party tax compliance software to manage your crypto swapping or trading statements is no good?
No, I'm saying it's a good idea to do that and keep it up to date. And if you need help from an accountant, seek that out. But definitely have that and have all the supporting documents behind it, because your auditor is going to want to see a statement at the end of the year, whether it's from an exchange or your public wallet. They're going to want to see in the name of the fund and what was there at 30 June each year. So that's one pitfall. The other one that I've seen is make sure to only make contributions to your self-managed fund in Aussie dollars. Some people in crypto, they've got stacks of crypto outside of super, and they want to use the super fund for the tax benefit. You can't contribute crypto into a self-managed super fund because it's not allowable. There are other assets you can do that, like listed shares, make what's called an in specie contribution, but you can't do that with crypto. Even if it's a stable coin, you need to convert it into Aussie dollars, put it in.
That's a big one.
Invest through the super.
That is big, yeah.
So that's a pitfall. Last one I'll say is, I'll just mention that be aware that the ATO and ASIC have released some statements on crypto in self-managed super funds. They're wary of the scams that are out there, and there are scams. So do be wary and do be vigilant. I think if you're in crypto land, you know that already. But for the unsuspecting people, be really careful and just know that's why you need to have those excellent records, because in some cases, the ATO might take a dim view if you've got crypto and you've done the wrong thing in your self-managed super fund.
Phil, we've spoken a bit about SMSFs, and now it's time to kind of take a slightly different path into something related that business owner clients may be interested in. A lot of you listeners out there already in business or may be thinking of getting into one. A way an individual can get into business without having to come up with their own idea and a lot lower capital to get in is to join a franchise. Phil, can you tell us more about franchises and just provide a couple of examples?
Yeah, so franchises, a business might become successful, and if there is a business that is looking to grow nationally or internationally, they might think of using the franchising model. And so the franchising model allows the franchisor to grant the right to another party, individuals, the franchisee, to operate their business using the brands, the products, the services, the systems that they've developed in exchange for upfront and ongoing franchise fees, but also ongoing support in most cases. So franchising is a popular business model in Australia. However, there are some successful ones we've seen, but also some unsuccessful ones.
Phil, what's an example of a unsuccessful one?
So one that comes to mind, and this has been in the headlines as of late, is F45. We've seen this year that there's been multiple collapses of franchisees due to unpaid debts, and they've gone into liquidation now. And just as of last month, I believe they're in the process of being delisted from the New York Stock Exchange. This was F45, the gym franchise that was backed by Mark Wahlberg and a few other celebrities, right? So it grew pretty quick. The biggest reason that they failed in Australia was, one, COVID lockdowns. So that saw huge restrictions on gyms, but also they grew too fast. They were pretty ambitious. And you probably see this with a lot of franchisor thinks about the money to be had. All they're doing is, let's scale, let's grow, let's get anyone on the street to join as a franchisee, and we can collect the upfront franchise fee upfront, but also the ongoing fees from the franchisees on a regular basis. And generally they're taking off the top line. So F45, another reason why they failed was because the business model was not sustainable. And being a trendy gym, they lost their unique selling point where competitors then copied them. And so that killed their business model. In the long term, people didn't really want to pay $70, $80 a week. And so sadly, the franchisees were left holding the bag. A couple of others that come to mind, and before I get into that one, we've also seen UFC gyms starting to collapse. There's a lot of, there's a trend. It's not uncommon, that's right. A couple of others that come to mind that have not been successful and not franchisee friendly. Gloria Jeans, Donut King, a flawed business and franchising model, which sent their franchisees into financial ruined marriages. There were financial implications for franchisees. But those two, along with other franchises, because of the bad model and the way they conducted their franchising model, led to a parliamentary inquiry in 2017, which reviewed the whole franchise code of conduct. There's a lot of recommendations that came through, but I feel now, because of that, the franchising industry now is in a better place. It's still not where it should be, but it definitely is a better place.
So given the risks, Phil, are you saying, would you advise people to steer clear of franchises altogether, or are you saying that something else?
Look, I'd say it's not all doom and gloom. There have been a lot of unsuccessful ones, but there are successful ones out there as well. You know, you've seen McDonald's and, you know, all the Aussies out there, the viewers, you've seen gyms. There's gyms everywhere. They take care of their franchisees as well. So there are good ones.
Bookkeeping.
Yeah, bookkeeping. They're even into book cleaning.
Yeah.
I mean, what you don't want to get into is an example of a donut king where the franchisor was charging their franchisees $3 for a donut, but then forcing them to buy donuts at $3, but then having them sell it to customers at $2. So they're already in a financial loss. So it's very prudent to seek legal and financial assistance before getting into a franchise.
So Phil, what are an example of some of the things in a business sense that the franchisor can control?
Yeah, there's a few things that they control. The first thing is the branding and the marketing. There's no, you don't really have control of what happens there. You can obviously use the brand and to market, but you can't control that. The franchise fees, unfortunately, you can't control. And generally you will see with some franchises, they will charge outrageous fees. And I've seen in some franchise examples where they're not only charging their franchise fees, but they're also charging marketing fees, which are at times a lot higher than they should be. And so those are the two things that you generally can't control, but also territory, the geography of it all. You generally, when you get into a franchise, you're limited to your area. And over time, as that franchise grows, there could be other franchisees that start to trench into your area. And then that then dwindles your bottom line.
Geography is a big one there, like resurveying the franchise area.
Yeah,
that
that's right.
I've seen too. And Phil, what about ownership structure of the business through which the franchisee chooses to operate?
Yeah,
Can
so
the franchisor generally control structure of the franchisee?
No. So that's generally controlled by the franchisor. Would want to tell you to own 100% or the majority of that because, and we've seen this as well, there's a breakdown in marriage. Or before I get to that, we've seen examples where franchisee gets into business, they set up their structure and they have equal ownership between their wife and themselves, but the wife has nothing to do with the business or the franchise. And then over time, the marriage may break down, and that's just going to cause a lot of trouble, one, for the franchisee, but two, for the franchisor, because now the franchisor has lost the franchisee because they can't operate due to that breakdown in marriage.
That's a big issue.
I know you've seen that quite a lot as well.
I have, unfortunately.
Have you also seen, in some cases, does the franchisor own some part of the franchisee's business or not?
Usually it's either the company, there are things called company stores where the franchisor owns the site that they operate from, or owns the territory that they operate from, and then they have an employee running that company store.
Yeah, so that company store or that area where no franchisee is in there, that's really owned by the franchisor.
Yeah.
They're fairly rare because the idea of franchising is to expand using the franchisee model. But they do exist.
Okay. And I was going to ask, Phil, you mentioned the fees. Are they typically fixed or do they depend on how well you do as a franchisee?
Yeah, so there's the initial upfront costs that you have to pay, the franchise fee, but then there's the ongoing franchise fees that you would normally pay as well. And that most of the time is based on the top line, on your performance. So you might have a lot of operating costs, but what they take is your top line. So that adds to, I would say that's a disadvantage as to why
it's a massive disadvantage. I would agree.
Yeah. Because
it's not about, in business, in any business, whether it's a franchise or not, it's not about what's turned over. It's about what's left over.
Yeah, that's right. That's right. And so if you've got a business model where there's high fixed costs and you have a down month or COVID happens again, they're still taking a percentage of your top line, the franchise fee, but then you've got all these fixed costs that you still have to wear.
Yep.
And so that could be disastrous.
Phil, what are some of the advantages and disadvantages of becoming a franchisee?
Yeah, but quickly, advantages. There's a proven business model, so you don't have to think about it. You can just get straight in. There's brand recognition. A lot of people already know about it and awareness. You do get training and support, And generally in some franchises, you'll have reduced marketing costs because it would be at times cheaper to use the franchisor's marketing versus having your own business and investing in all the different types of channels that there is in marketing, which can be costly, especially if you're starting up. Disadvantages, the franchise fees, which we've already gotten into. There's lack of control and independence, shared profit sometimes, and the limited territory. So, at the beginning of that expansion, you might have a good sized territory and you're getting a lot of money, a lot of revenue coming in. But as it gets saturated and it grows, like F45, for example, the area shrinks or your customer base starts to shrink.
Kind of like dilution.
Yeah, correct. Over time. So it's always good to get out at the high.
Yeah.
So Phil, for all the prospective franchisees out there, what should they consider before joining any franchise? What are some of the things that you would recommend that you've seen that people should consider before joining?
Yeah, thanks, Chris. The first one is engaging with a solicitor to review the franchise agreement, disclosure documents, having them convey to you what you're about to get into so that you fully understand. The second one is using accountants to help you understand a few things. The first one is if you're getting into an existing franchise, you want to understand the historical financial performance, but then also projections going forward. Understanding the total franchise cost and financial commitment that you need to outlay. There are some instances where finances is provided, so understanding that as well. And the third thing is to understand the cash flow break even or the return on investment. So the first bit is understanding, if you're getting into this, how much in revenue or sales do you need to generate in order to break even, so that you know how much break even in terms of cash. So that includes expenses, repayment of loans, payment of your wages. So you get a good idea of what you're getting into financially, but also how many years it's going to take for you to repay all the loans and get your money back before you can start to receive that financial benefit of getting into business. The third thing is to understand the market, the competition, and the territory that you're in. Have a think about what's coming in the next couple of years. Will there be a lot of competition? Will other people start to encroach, then dilute your territory? And if so, then you would want to consider exiting or not getting into it. The fourth one is avoid trends. So gyms, for example, is one franchise model that you would want to avoid. Hospitality as well, because as we've seen, they generally turn over. You walk down your suburban shops, 3 years later, there's a new gym, there's a new retail shop where the old one was. So I would try and avoid those. But if you are getting into it, then think about the exit plan, which is my fifth thing to consider. Having a plan in place for how you will exit the franchise if things don't go as expected. And in business, you always have to have an exit plan. Those are the five things to consider.
Yeah, that's a big one, that exit plan, that last one.
Excellent. All right. So that's all we have time for today. Thank you again, viewers, for joining us. I hope you have learned something valuable. Please share this podcast with your network, and we would love if you left a rating and review. Until next time.
Cheers.